Last month, my portfolio ended at about $440,000. Pretty steady right until a tiny market wobble hit, and suddenly, boom, it dipped down to $429,000. That's a 2.7% drop. And then it bounced back up to $447,000, even though I added over $4,200 this month. But here's where it gets interesting. Paul's income portfolio reacted totally differently, even though he didn't add a single dollar. So why did the same wobble split our portfolios apart? Why did mine drop a little and then recover while Paul's dropped way more? And what does this tiny test reveal about growth versus income, especially for investors who are tempted by high yield cover calls? Before we jump in, here's the big reveal. Paul, you hit an all-time high around 447,000 as well. Then during this wobble, you dropped to, well, okay, Paul, why don't you tell everybody where did things go this month?
All right, Darren. So yeah, you're right. Back in October, the 27th, I hit my all-time high was 447. And then I just want to check and make sure I got the right. I actually hand write these things down. So I think it was November 21st, my lowest was 385. So I dropped down, I think it was a total of like $61,000. I dropped to 385. And then it started going back up again. And currently I'm sitting at just over about maybe 407. I haven't added up my numbers yet today, but I did get back to over 400,000, but nowhere near the all-time high that I was at.
All right. And this wasn't a crash. It was barely like a little wobble, right? Like I said, it was only about 2%, I guess. Doesn't even come close to what some would call a correction or, a big downturn as defined. I think those are like 10%, 20%, and then far worse than that. So a little wobble. And it's interesting to see the differences between, our portfolios, how they reacted. So I thought it'd be kind of interesting maybe to touch on maybe what we saw in our portfolios that did react both positively and negatively.
Yeah. So actually, Darren, you're right about that. And I had somebody correct me in one of my, I made a video and I mentioned, I think the word crash, and somebody commented down below, like the market's, at all-time highs. There was no crash. What is this guy talking about? And I guess I was thinking about my portfolio specifically, as opposed to, I don't often look at where the, S&P 500 is at or where the NASDAQ is at, because all those things don't really matter to me. And actually, I watched a good video from Mark Beavis where he talked about why does everybody measure their portfolio against the S&P 500? Shouldn't you measure your portfolio against your own goals? And for me, that's the important thing. But anyways, specifically for my portfolio, Bitcoin dropping and strategy crashing. I looked it up. I think in the last 3 months, strategy's down something like 40% or more. So just those two factors alone hit some of my positions pretty hard, right? And my MSTE position from Harvest was one of my largest positions. I think I had about $50,000 invested in it, and you got to figure at an average price of $15 a share, and now it's below $6 a share. That's one of the things that's like affected my portfolio a lot. Also, anything I have that's affected by Bitcoin, like any ETF that has coin in it, so my CNYE. And keep in mind, Darren, these things are also using leverage, right? So when they go up a lot. When they go down more. So I'm just kind of at a point right now where my portfolio is down a bit because of a few of these ETFs. But again, it's not really something I worry about because I feel like they will recover and they're going to keep paying the monthly distributions. I'll be able to buy, I'm going to buy more for sure at these prices. And, but at the same time, I am looking at some positions in my portfolio that made it through very smoothly, and adding to those, what I call defensive positions, just to build my base even further. I think we kind of get, at least me, I kind of get maybe a little bit suckered into some of these tech stocks, and overweighted in them, which you have to be careful of because the highs are high and the lows can be low.
Yeah, that's actually a really good point, and I think that goes to this idea of diversification, right? So
Yeah.
I think that while your portfolio did react to this little change in the market, we'll call it, and it's cruel to see that, even myself, I have to remind myself, like, what is a real correction, right? There's some hard and fast numbers that help define that in general. So yeah, I thought it was a big one, but clearly, even after looking at it, we didn't even get close to 10%.
No.
So, but I think diversification is key, and both of our portfolios, we have that, and I think that's what helps protect a portfolio too. I don't know, maybe you folks in the audience here might disagree, but you're talking to two novices here who are
Yeah.
still trying to figure this out. But I would suggest that the fact that you do have a lot of positions, how many is it again that you have total?
So the last time you and I spoke, I was I think a little over 45 positions, around 45, 46 positions. I did trim. I got rid of some of them. So I'm down to 37.
Okay.
Yeah.
So that in itself, I think, helps spread the risk out.
Yeah.
Like before we started recording, we we were bantering about some stocks, and one of them was Alti. With higher risk comes the possibility of higher returns, but it also comes with the risk of the downside, which is, I think, important to acknowledge for the audience who, if you're sitting back and you're watching this, and whether you're our age or younger, whatever, always consider those with your risk tolerance. And I think that, like you hold Alti. I don't. I think I'm actually a little afraid of it. I am going to do a video on it. I'm going to try to explain it from the novice's lens, as I learn about. There's a lot in the strategy in that fund, but what I do know about it is when things were good, it produced a lot of income,
Yeah.
but it's not good all the time. So I think in your case, how much do you have in it again?
I had just before the split, I had 1,600 shares. So now I'm down to 160. Of course, at the new
Yeah.
price, right?
And so for a portfolio of your size, above, well, you're just above $400,000. That's a very small percentage. I think I've heard that, people say like, oh, if you are not completely, good conviction on something, you make sure that if you're willing to invest in it, that you're willing to give that money up. Will that ever happen? I don't know. I guess it could happen, but so far I haven't seen that. I haven't seen anybody on Blossom, or I haven't seen anybody say, hey, I had this position and it evaporated to zero. But that is a possibility.
I've had, to be honest, Darren, I've had investments that went to zero, but they weren't income funds, right? They weren't covered call ETFs or anything like that. They were, I had one of the pot stocks, from it's actually local, pretty local, just outside of Grimsby, went to zero. They got delisted. And I had some meme stocks that got delisted. So I did learn the hard way some of the investments that I will never touch again. You know what I mean? I like to stay away from small cap. I get burned. I buy the wrong small cap stocks, so I don't try with those anymore. But no, I think Alti, they'll just keep reverse splitting it if they have to, right? So it'll never go to zero, but how much you make per month is going to keep going down if they don't figure out how to fix this fund.
Yeah, it's definitely gone through a number of changes. I think one of the keys there is that it has a lot of, it's not just like a single stock ETF or a single stock position. I think you increase your risk, like you mentioned there. You hold one stock and that company goes out of business. Well, clearly, if it's delisted and doesn't exist, you're going to lose your money. But
Yep.
I guess in this case with Alti, it has, I'm not sure. Oh, it's between 20 and 30 positions in total
Yeah.
within it. So the I think that reduces some of that risk. Now, that doesn't mean that it's the best fund to invest in, and I guess that's the key here, and that's why I wanted to do this with you. Is there are funds that you understand, I think, better than I do, because you've been investing in them longer than me. Um, but I'm learning more about them, and again, I think there is a space for these funds, the covered call or income funds. And Alti is definitely a very unique one.
Yeah.
But I wanted to ask you, like, so I think we talked about this off camera, but uh, for me, if you saw my month end video, it was a bit of a step back, another one of these bumps, like at the beginning of the year, where I was like, oh man, like my portfolio dropped. For me, it was about $10,000 in my portfolio, and that feels pretty significant to me.
Hmm.
Though when I step back and I look at things, I kind of felt like, okay, this is just a little speed bump, but it took a bit of perspective to kind of figure that out. Like I've said it before, if you zoom in on that one moment, it looks terrible. If you zoom back out, you go, okay, well, it wasn't that bad. Uh, Given the larger change in your portfolio, I would describe yours more like a pothole than a speed bump. But how do you
Yeah.
actually feel about it?
You know what, Darren? I do the same thing as you, right? When I go on Wealthsimple and I look at my portfolio, I also have some money with RBC, which I'm considering abandoning them, but that's another story for another day, I guess. I when I go on Wealthsimple, I take a look, for example, at how has my portfolio done in the past 3 months, right? How's it done in the last 6 months, 1 year, and then I look at the all time. So a month ago, my all time, I was up about 107%, which I'm happy with that. As long as it's generating my monthly income and I'm up 107%, I'm okay with that. So right now, I think I'm up about 89%. So not as good, right? Not as great as it was. But still, when you think about it, if you zoom out and you're up 89%, that's not that bad, right? I'm not, if I was down 89%, then I might think, okay, this whole income thing is not working. You know what I mean? I got to find something better. But as
Yeah.
long as my portfolio is in the green over a longer period of time, like if you look at 1 week or 1 month, I might be down a few $1,000s or whatever. But yeah, I always zoom out, and I think that's what you have to do, right? You have to zoom out and see how your portfolio is doing over a longer period of time than just a week or two.
Yeah. So like in my portfolio, obviously the like XEQT that I hold, VFV, VU, those were, I guess they reacted the least. Doesn't mean that they didn't drop. Everything dropped in my portfolio. I think at one point, pretty much every position looked red at one particular time or another. And then the covered calls, which in this case was HHIS, seemed to react the most. But you've already identified kind of what that was likely driven by is more the Coinbase and some of the other funds that are contained within these. So uh, they are held within these funds, and when they drop in price, we know that with covered calls or income funds, you're not protected from that downside slide, and the recovery is a bit slower. So it's the way I would frame it is it's not unexpected, right?
No.
You've been doing this long enough. So is how would you tell the audience about, how to prepare themselves when this was like a 2% drop in the market? What would 10% look like, and how should they prepare for that?
Well, I think what I'm learning more and more, Darren, is that you have to build your portfolio. Even I guess your portfolio as a growth investor, you talked about XEQT, which has 8,000 positions in it, right? And VFV is similar. As I'm building my portfolio moving forward, I'm looking at funds that don't just hold one single stock, right? Because then you do have more exposure, to the downside, right? So, for example, with my U.S. listed ETFs, instead of buying more Alti or something from YMAX, I'm starting to add more to my Tap Alpha positions, which hold the S&P 500 and hold the Nasdaq, right? And if you look at their share price, they go up 50, 60 cents, and they go down like 10, 20 cents. Then they go up, then they go, you know what I mean? But they're almost flat, right?
Right.
But they keep paying that 14 to 17% distribution, which is which is the part that I like, right?
Yeah.
Um, yeah, so I think that, and then another thing that newer investors have to realize is that you can't just get caught up in like Alti. You know what I mean? Oh, look at how much money people are making on Alti or something similar, and I'm going to put in $100,000. You know what I mean? And then 2 months later or 3 months later, when their 100,000 is now 70 grand, you know what I mean? Maybe if they had to put in $1,000, they would have been okay and put the
Yeah.
rest of the money into something safer, right?
It's almost like it's like an ETF. I know that sounds like a silly analogy, but because you have so many positions, you're creating your own ETF.
Yeah,
Like, and as a result of, some would describe it, I suppose, as diversification. But at the end of the day, you're spreading the risk out, like you just described. So instead of putting everything into Alti and watching it, go through what it just did and bottoms out on the price, and you're not sure if you're getting your own money back or not. You're on the other side of the coin. You're getting, no pun intended there. You're getting some of your other funds are paying, on regular distributions because they might be trading sideways, which is when these funds typically tend to do better. Maybe that's not the right way to frame it, but that's when you're going to get the best of the premiums that are being paid on the call options. It's in these volatile times that in some cases you're probably getting your own money back, and in other cases, and that's simply because the fund just can't generate enough income at that point in time. But again, zooming out, it would probably level itself out at some point, I suppose. Um, so I wanted to explore this a bit. Did this month expose any sort of big risks of, and you kind of touched on this, but going 100% income, which, that's what your portfolio is like. What would you say if somebody was saying to you, like, I'm new and I want to get into this, I want to go 100% in income?
Um, to be honest with you, Darren, I mean, like the last month hasn't really been much different than the last couple of years. You know what I mean? There's been periods where my portfolio skyrockets and I hit kind of like an all-time high. One of the dates that is in my mind is December of 2024. I hit an all-time high. And then what happened, right? From December to April, right? Liberation Day, my portfolio dropped. And I think at that point it dropped about $95,000. Well, you're talking about your portfolio dipping 10,000, imagine 95,000, right? So I went down that 95,000, but again, I was still collecting my monthly income and my monthly income was still growing, still going up. And then from there in April to October, all of a sudden I'm at an all-time high again. You know what I mean? And so right now it's just like this really is more or less a buying opportunity for me. You know what I mean? Just taking a look at my portfolio, which positions are down the most, which ones do I want to add to? But at the same time, one thing I've learned in the last few years is that tech seems to be kind of cyclical, where people love technology and then they get out of technology, kind of like Bitcoin, it goes up to what was it, $126,000, and then all of a sudden is back down to like 80 something. I don't know if it's just big players are like, hey, we're at 126, let's sell, make our money, and then we'll buy back low again, right? But anyways, when technology seems to be dipping, all of a sudden your oil ETFs, right? Your banks, your utilities, they seem to perform a little bit better at those times, right? So I think it's like you said, diversification, right? It's about having a balance and making sure that you have enough non-tech investments to kind of like hold down the fort when technology is dipping like it is right now.
Yeah, that's for me, that's sector. So I like that. That's actually a very simplistic or holistic way of looking at it. Is when that's why diversification is important, not only in funds but also in sectors like you just described. And in my portfolio, it's very similar, where I have percentages in my asset allocation in North America, international markets, emerging markets,
Yeah.
some real estate, and then Canadian stuff. Uh, I have a bias as far as percentages go. And then if you look at XEQT, it's exactly the same. Like if you look inside of XEQT, you'll see that same asset allocation where it's
Mm,
percentage wise spread out. And so that is, the same idea. It's just the yield or the income is far less, and the growth in the stock price is where you see the appreciation. It's like my last thumbnail for our last video where there's the tree with the apples. So that's
yeah.
growth where eventually we're going to keep picking more and more apples from the tree. Or in the case of an income investor, you get your basket of apples right now because somebody gave them to you, and that may remain consistent. It may get less, it may get more, you just don't know. But in the growth side, it's sort of you're growing that tree to produce more and more and more. And then you have to figure out, which you touch on a lot in a lot of income investors, you have to figure out what's the best way to capitalize or utilize that money. By selling shares is usually the way that it happens. Because I mean, unless your portfolio is big enough to produce enough dividends in retirement that you could survive on, sort of thing. So I like that analogy of the sector part, and your portfolio is constructed that way. Have you actually thought about like breaking down each fund to determine a bit more precisely where those sectors sit?
I started to do that a couple of years ago, and to be honest with you, I kind of gave up on it. Just too much paperwork for me. Um, I had this thought about a year and a half ago when my monthly income hit about $5,000 a month. It was like, okay, if I wanted to retire now, that $5,000 a month would cover all my expenses. I would be okay, right? But you're better to keep going, right? Keep working, keep growing it, get it to the point where it's a lot higher so that if when it does dip, when you have those months where distributions are cut, things are not good, volatility's low, for whatever reason, premiums are not there, and all of a sudden your monthly income drops by 20% or 30%, you're still okay. So it's almost like you really have to have a buffer. And, not only that, but there's inflation, right? So it's gonna, your expenses can go up over time, and you want to have some money to reinvest to keep growing your income as well.
Yeah, it's interesting because some people go all in on income. Well, I guess that's kind of what you're doing right now. But how do you keep the engine still working in the background, like you say, with when that volatility shows up? And then there's also the idea that, like, and I'll just use Alti because it's the one that you and I have been talking about, but we're both kind of researching a little bit because we both want to talk about it on our channels. But when that price drops, that's when that idea of total returns becomes very important.
Hmm.
Where with growth funds, you don't really need to, yeah, total returns is important, but it's not the same because, yes, the distributions could get cut, the price would change, but I don't need to worry about my total returns because they're pretty obvious to me. It's included in the share price. Where
Yeah.
with income investing, you do want to pay attention to that. And let's say you were retiring and for whatever reason you had to sell some shares. Ideally, in an income situation, you wouldn't want to, but that price drop, even though it's total returns, that could affect you. The other thing is that on a monthly basis, those distributions, most of the time, when I'm watching videos or hearing people talk about it, the ideal circumstance in income funds is to reinvest the distributions back into the fund. That's what continues to make it grow. But, and so this is going to, I guess what I want to know is like, do you think about that? Because most people that want to retire, or in your case right now, you are utilizing that. You're not reinvesting it. So you're not optimizing the income. Would there be an opportunity? Well, first of all, I guess my question would be like, do you think about that? Is that important? And secondly, have you thought about introducing maybe some growth? I know you mentioned to me at one point, maybe XEQT or something to maybe offset that, like I don't know, some percentage. I know that could be like 60/40, 80/20, whatever that looks like. Have you thought
Yeah.
about that?
I have thought about it. And to answer one of your questions, like right now, for example, HHIS is my largest position. I think it's around 19 or 20% of my portfolio. So this month, I think on Friday, I'm going to get, I don't know, say $1,500 in dividends from HHIS. I'm not going to put it back into HHIS because it's already my largest position, right? And I don't want to keep making it bigger and bigger and bigger. So I'll take that money and I'll add it to other positions, you know what I mean? That I want to, HHIS is very technology and it's US listed companies. So I'll take the dividends and I'll say, for example, buy something, maybe Canny from Evolve, where it's Canadian listed ETFs. So I'm still growing the portfolio. I'm just not doing it within the same ETF, if
Right,
that
so you're
makes sense,
taking
right?
a you're yeah, no, it does. So let's say, I'm just gonna use Alti again because
Yeah.
it's popular right now and the price is taking a real hit, but let's say I think it's trading somewhere around the $4 mark before the split, and then you're gonna take the HHIS distributions, invest it in Alti in the hopes that when that price recovers, you see some appreciation as well as an increase in your distributions. Is that sort of
Yeah,
characterize that?
yeah, you could do that as well, right? You could take a more stable fund like my HHIS is still in the green, even though it's come down a little bit, right? So I'm still up on that position plus all my dividends. You could take dividends from that and you could put it into Alti, just to try to increase that, your position in Alti if you wanted to grow it. The other thing to answer your question is a few weeks ago, I did decide to start a position in XEQT. Sean decided to start a position in FEQT, right? So we're each buying every week and we're going to compare the two to see which one over time outperforms the other. But it also, I think it is nice to have a little bit of growth in my portfolio. I put it in my RSP because I'm probably not going to touch that for, maybe 15 or 20 years and just to let it accumulate.
That seems like a smart thing to do, especially with, I often thought that I only had whatever I say, like when I started, I would have had 10 years before I was going to retire. I guess it's like 8 now. But when I sat down and I actually thought about it, I was like, actually, it's a little longer than that. It could be upwards of 15 or 20 years. And for a fund like an all in one fund like those two, you could definitely have some great benefit from just letting that money sit there and grow and however you decide to add to it. So, I think that's why, like for me, I have some covered calls in there because I do see that they have a place. It's just trying to dial in and make sure that I have ones that won't affect my portfolio too badly. So right now, the total I have is 12%. I was going to go to 20%, but I'm going to hold off on that. So the monthly distributions right now for the whole portfolio, including the cover calls for me, is sitting around $1,200.
Hmm.
And I base that on what my pension would be because that's what would be supplementing that if I was to say retire tomorrow kind of thing.
Yeah.
And I also know that as my portfolio grows, which it will, because I set a target, my target was 500,000, but I've actually increased it after I used my retirement calculator. I realized it needed to be a little bit more. It's going to be 577,000 will be the mark I want to get to. So as the portfolio grows, those distributions will also grow. So I find when I first started, I was looking at what I need to do today, but you also need to look long term, not only at what will I be down the road, but what am I going to do in retirement? Like you mentioned with an RRSP, you might
Yeah.
not touch that for a long time. You might just be dealing with your TFSA.
Yeah, well, for myself, I was thinking maybe between now and the age of around 70, if I just buy XEQT every week, just add even a small amount. I think right now we're doing $50 a week, but that's 18 years, right? It will actually accumulate to a reasonable size. Um, and I'm buying it all with dividends from my covered call ETFs. So it's not like I'm out of pocket to invest in it.
Yeah, exactly. Yeah. So I have a maybe a pretty obvious question, maybe not, but so part of distributions we know is return of capital or ROC, and
Hmm.
that's basically you getting your own money back. So the obvious question here is, does that cash flow feel as stable once you understand where it actually comes from? And how do you feel about that?
Well, if you have an ETF, and maybe Alti is a good example of one that's that's say returning your own capital, then yeah, that's not a good thing, right? That's why the NAV erosion's occurring, and they're stripping away the actual ETF itself. But a good fund provider like say for example Harvest, right? They will only pay out what they make in premiums most of the time. Some months they pay a little bit more, but then other months they make it back, right? So it's kind of an average over the course of the year. But you can see Harvest, they dropped their MSTE distribution from I think it was 60 cents or 65. They dropped it to 55 to 45, and I think now it's at 35. So they could have kept it at 65 cents and just kept giving you back your own money, right? And they would have hurt the fund even more than it has been just from the share price dropping. But yeah, a responsible provider will lower the distribution. And I think, a few years ago when HYLD did it, I was kind of upset. It was my largest position at the time. And I thought, why are they decreasing the distribution? But, in fact, it was actually, a prudent thing for them to do, decrease the distribution until they started making more premiums. And since then, they've increased it.
You got me thinking about something because I have been, as I said, I've been researching Alti to try and gain a better understanding of how the fund works. And you're hitting on something that's important because with yield max funds in general, I speak generally here, they offer, these outlandish returns of like 80% and things of that nature on the yield. And, I think that gets a lot of people's attention. But it begs the question then, because with these income funds, as you and I have discussed, is they respond in market trends, and in this case it was a downward trend, and then the fund managers have to respond accordingly. Which in this case, in HHIS's case, they're cutting, or sorry, which one was it again? You said Misty?
Oh, MSTE.
Yeah, so they're dropping those distributions so that they're not returning your capital in order to maintain what they promised. And maybe that's one of the issues with yield max funds. I'm not entirely sure, but if they're not cutting them, it's like I think Enbridge did the same thing, and for the longest time, like, they just some of these bigger companies like to keep their distributions, so they keep the investors on side, and I'm pretty sure that, Alti is, like, I'd have to look it up, how much is under management right now as far as I think it's in the billions, like 51 billion. Let me have a look
No,
here.
maybe 5. So what happened to Alti was their assets under management were, I think, below $1 billion. And then back in, I guess it was April or May, when they kind of corrected the way they were running it and it started to appreciate, their share price started to go up and they were paying weekly, like 9, 10 cents. Darren, so many people got attracted to that their assets under management went from, I think, just below $1 billion to like $5 billion within a few months.
Yeah, it's,
And
1.36 billion according to today.
yeah, see how much
That's what it
it's
looks
dropped
like.
because people have been
Yeah.
bailing on it, right?
It's funny because I just looked at it the other day, and that's why I came up with 5. I was wrong. It
Yeah,
was more 5 billion. So yeah, people are reacting to that for sure. That's
yeah,
pretty interesting. Like that, it's like, I used that analogy before, the car dealership analogy that they're trying to sell you a product. So their MER is 1.4% now, or yeah, 1.40%. So now the argument there is that the fund managers are constantly, doing work within the fund to make it work. That's kind of how it works. So that's how they justify it, I guess. But then would wonder, like, how much are they actually making on,
yeah.
is this something like we're selling you, for those of you that are our age, a K car instead of a Ferrari kind of thing? Uh,
Have you watched any interviews with the new spokesperson for Yield Max? I think his name's Michael Coe.
no, I
He's
haven't.
he's he's the new spokesperson. That Jay Pestrcelli doesn't seem to do interviews anymore. But anyways, Michael Coe kind of explained how Yield Max works by their prospectus, right? Because they can't just make things up, right? So they have to follow their prospectus. The problem is that the way they design those funds, they do really well in certain conditions, but in bad conditions, they don't do well at all. And part of the problem is that they write, I believe, on 100% of the portfolio. So it really leaves not a lot of upside to capture. You know what I mean?
Right.
Yeah. And then of course they capture all of the downside, right? So when times go down, they capture all of it, but they never seem to be able to recover from it. Where a lot of Canadian companies, they will write on 30 to 50% of the portfolio, right? So if they hold, say, like Tesla, say they hold Tesla shares, they'll use 30 to 50% of those shares to write their call options or their strategy. The other 50%, or 50 to, I guess it would be 70%, they don't touch those. So if Tesla was to run up to $1,000 a share, they would get all of that upside. Only the 30 to 50% that they've written on would get capped, right? So I think it's just the way that YieldMax has designed their funds. They seem to do well for a while, and then as soon as the market turns on that particular stock, they never seem to recover.
So that actually hits on, I think, an important point then, because I do know that yield max funds, like when I started investing and bought one of them there, QQQY,
That's
I didn't
defiance.
understand. What's that?
That's defiance.
Oh, sorry. It wasn't Defiance Fund, but either way, um, they use a synthetic strategy, and what you just described makes a lot of sense to me, because if they don't hold the underlying to write the call options, I think when they use synthetic strategy, they're using treasury bonds or something to back it.
Yeah.
uh, then like you said, then they can't capture any of the upside of the stock that they actually hold. So I guess that kind of makes sense why they hurt so bad when things get really bad, versus a fund like HYLD that's been around for a long time, that's a fund of funds, and it is diversified with inside of the fund. So when one
Yeah.
portion, like you said, like tech is doing bad, but let's say, I don't know, some other portion of the market's doing better, it kind of offsets that. And I think that HYLD, do they write on like 25% leverage, I think is what they use.
I think it has 25% leverage as well. Yeah. Yeah.
So compared to the yield max funds, there's less of a risk in that strategy. So then I do wonder, like, maybe I should study a bit more about, like, when has it been so good that whether you have 1,000 in it or 100,000, when has it been so good that it makes it that good? Because everything I'm hearing about this particular fund and any other yield max funds doesn't make me want to look at them at all.
Yeah. They do have, I don't know if you've heard of Chippy. They do have one fund called Chippy, which holds a basket of stocks that I guess are all in the microchip industry. I'm assuming that's why it's called Chippy.
Right.
And it's done so well. Like since it's launched, it did well. Then it dropped during the whole drop back in April. And since then, it's recovered. Its share price has recovered and it's fine. So, for some reason, whoever's managing that particular ETF, they're doing a great job. And the other thing the YieldMax did was people got so upset about, all their other funds, their single stock ETFs tanking. They decided to come out with a target 12 set of ETFs. One of them's called Biggie and one of them's called Soxy, right? So they intentionally came out with funds where they were going to try to get a 12% yield. So instead of writing these crazy calls trying to make 80, 90%, they cap it at 12% and the funds are doing fine, right? Because they're
Right.
not overwriting on them and trying to get these ridiculous yields. Apparently now they're coming out with target 25. So they're going to kind of go between their target 12 and, their crazy funds. And even those ones might do okay, right?
So that's an interesting perspective. So, and I know that you've heard this before, I'll say. So if that's the case, if writing calls and having 12% as a target so that the fund doesn't, I guess I'll use the word collapse,
Yeah.
or run into the ground or return to capital or whatever, then why do so many income investors not just look at just carrying, like, I don't know, well, we'll just use XEQT as an example, but I guess what I'm trying to understand is, like, what you're saying is that it's in the so risky parts of income investing, the funds collapse. So we have to dial that back and it's like fine tuning. But is that fine tuning reaching the goals that an income investor wants?
For a lot of people it is, right? I read comments and that from a lot of investors who only stick with like say HYLD and HDIV, and BMAX, and in the States they have the NEOS funds, which are SPY-I and QQQI, right? And they're all sort of in that 8 to maybe 14% range, right? And if you have enough money, maybe $1 million portfolio, you'll produce enough income that you can survive on it. Whereas if you were doing a 4% rule, at least the way I understand the 4% rule, if you have $1 million and you can only withdraw 4%, that's 40,000 a year. I don't know who's going to live on 40,000 a year, right? So then you have to have $2 or $3 million in order to pull out 80, or 120. But if you
Yeah.
have, so no, there are actually a lot of people who are more conservative who stick with the more conservative funds and they don't even bother with, Alti or, any funds from Yield Max, Defiance or whatever.
That's also a great point is, when you get to the end of the game, when it's time to start drawing down on that money, you have to figure out liquidity. How do you make that money available to you
Yeah.
in an income investor's space? That means that the distributions that you're getting are that liquidity for you, so that if you needed that money, and like you said, it could be that, let's say your distributions are, I'm just going to use a round number, 2,500. That's where your portfolio sits. And if you needed 5,000 a month, then you're going to have to come up with the rest of it. And that likely means selling shares. So I guess that's why it's important to come up with or use a calculator or whatever, like I did, to figure out what is the optimal amount that you would need. And in the income space, it would be the same would be true because, like, in your case, you're setting a benchmark. Based on the funds you hold, how much you can earn on your income. And so I guess that sets you up for when you have to look at that 4% rule. And by the way, the 4% rule, from what I understand, is ancient now because of inflation and whatnot. But you set that up really well, I think, in the sense that people need to think down the road. Okay, I'm making this now, but if I don't contribute any more to this portfolio, what will it look like down the road? 2% inflation every year, increase in costs, and so on and so forth.
There's also, I mean, life is not this easy and simple, right? It's more complicated than you think, right? Because you have, for example, in Canada, we have your Canada pension plan, right? You got your old age security. So those are all going to kick in eventually, right? You might have parents who are elderly. At some point in time, they're going to pass away. Not everybody, but some people might be lucky enough that they're going to inherit some money, which will all kind of get thrown into the portfolio. Um, you have a pension. My wife has a couple of smaller pensions, but eventually that'll all get, added in as well. So there's a lot of different variabilities, right? I own a house. Someday I can sell my house and downsize. That will give me more money to invest. So there are a lot of things you have to consider, when you're looking at your own retirement strategy. For example, when you talk about your retirement numbers, I don't know, how much are you thinking about making on a monthly basis? You know what I mean? Your pension plus how much, right? And it's individual to everybody.
Yeah, it's totally individual. I base it off of some of the expenses and whatnot that we have right now, and I chose a number, but that number has been influenced, which I might change. But the nice thing about the calculator that I use is all of those pieces of the puzzle you add in inflation, the growth of the portfolio, and all that. So you're right, like you what you think you might need today might change, and you're right, there are a lot of variables that can influence that. So you know the investing part is fun, but a lot of planning needs to go into it as well. I think that's the big thing that I'm learning as well. Like, I thought it was simple, but I don't think it is, because there's a lot of tax implications depending on where you're taking it out, when you're taking it
Yeah.
out, and then you also have, like you say, your CPP and whatnot. So there are a lot of other components to think about as far as planning goes. So I think this comes at a good point here. So you said that many times that your goal isn't to be a millionaire. I know I said the same thing. You just want income, and in my case, I just want enough to build the portfolio to sort of so that we can live reasonably in retirement. But a lot of new investors watching you and me, they want wealth. So the big question here is, can a cover call portfolio actually build wealth over 20, 10, 20, or even 30 years? Or does it mostly create income and slow down the compounding injury over longer periods of time?
Well, I think, if you watch a lot of Adriano's videos or Jordan's videos, they talk about using income funds as growth funds. And I think what they mean by that is, take a particular ETF, like maybe HYLD, but put it on drip, right? So you have to put it on drip so that every month, instead of you taking, whatever it pays 15 cents a share and putting it in your pocket or whatever, you're reinvesting it. So instead of having it pay you out, which is basically what they're doing, right? They're paying you out like a dividend, or they're reducing the NAV, right? So whereas XEQT doesn't do that, they keep basically all of the money in the portfolio and it grows. So that way you have to take your HYLD or whatever fund it is and just put it on drip and keep buying more shares, which will pay you more month after month after month. And some people believe that this is a way to turn a covered call or an income investment into a growth investment. I don't know
Yeah,
if
that makes
anybody's
good
done it
sense.
over long enough time to to prove it for. I guess you can use a calculator and figure out if it'll work or how much it'll pay over time.
Yeah, I mean, there's one website that does it looks at total returns. I'm actually, if you guys are watching and you know of another one, I only know of one website that I can do that with, but that it allows you to see total returns compared to not total returns. And I agree, the big thing in anybody's portfolio is total returns, but for income investors, it's really important as far as the growth end of it. If you want to look at it like you described, if you don't reinvest the distributions, those won't perform nearly as well if you did reinvest them.
Yeah.
So I guess that's why I had previous asked that question. I guess that's the hard part for a lot of people to get their head around is total returns matter. But if total returns are that important, doesn't it make sense to hold something like XEQT in a portion of your portfolio to allow that growth while you're drawing income and find a balance between them, I guess? I know for me, like I said, I'm not looking to be a millionaire. I mean, gosh, that would be great, but
It would be
it's not
nice. I
realistic.
wouldn't complain.
No, definitely not.
Yeah.
But it's not really realistic, I don't think, as far as like growing the portfolio. So for me, I want to maximize what I can in the asset allocation that I currently hold, and see the portfolio grow. So I think that's why our conversations are kind of interesting to see how the portfolios react, what's happening. And by the way, I mentioned this before, but I just want to reiterate it. There is a bit of an unfair advantage on my part because I am contributing to this portfolio. That was made pretty clear. But with that all being said, I don't think it's unfair in the sense that if your portfolio started to steadily decrease on a regular basis, I think that that would demonstrate that maybe it isn't working. I think the difference would be there might be some way to calculate by removing my contributions. I'm not sure, but at the end of the day, um, we are just trying to grow our portfolios for us. You mentioned that. This is
Yeah.
not measuring against other people, not measuring against benchmarks. I mean, that's always nice, but at the end of the day, I set a goal and I want to reach that goal and I want to get there as effectively and efficiently as I can. So we were talking off camera before we started this, Paul. You mentioned that you've introduced something new into your portfolio. I was kind of excited to hear about it. Can you tell us what's going on?
Yeah. So I decided to take the plunge into using margin. And the one thing that I'm sure Darren and I would both like everybody to know is that margin is very risky. Okay,
Yeah.
you can definitely lose your shirt using margin. Actually, somebody posted on Blossom, this poor lady. She took her margin account and put it all into Alti, MSTY, and MSTE. Okay, so right now she is out a lot of money and I think she's being margin called. So I would highly recommend not doing that. And to be honest, if you don't have, I would say at least 5 years or more worth of investing experience, I wouldn't even bother considering using margins because, you know, you probably don't have the stomach for it and the understanding of investing and everything else. But anyways, I decided to go for it. You know, I spoke to some people who use margin, try to figure out everything I needed to know, and I went in real big and bought like $500 worth of Utes, which is a utility covered call ETF. But if you watch it recently, the share price literally goes up and down, maybe 20 cents. 20 cents up, 20 cents down. It's very consistent, and it has a 30% margin requirement, which is I think there's 30, 50, and maybe 100 are the three levels. So I'm going to stick with the 30% margin requirement ETFs that are on Wealthsimple. So I bought Utes and then I ended up buying HDIV and then ENCL. And what I do is I just buy $500 at a time. And once I buy one position, I watch it to see if it dips a little bit. And if it dips a little bit, I'll add another $500. And I put together a spreadsheet as usual to keep track of how many shares I have, how much it's going to pay me. And if you go on Wealthsimple on your margin account, it shows you exactly how much interest you owe every single day. So for the course of the month, it accumulates your interest. So every day you can see where you're at for that month. So I mean, the whole goal is that if by the end of the month I owe $10 in interest, but I'm making $30 in dividends, then I'm up $20. Of course, it's taxable, right? So you have to take that into consideration as well. I'd like to build my margin account to maybe around $10,000 and see how it goes, and then eventually maybe build it a little bit bigger, and eventually it might be another stream of income, another source of income.
Interesting. So, when it comes to margin, you mentioned that it's taxable. As far we've already talked about this, there's more to just like if you looked at what you're talking about right now in this like narrow scope and said, "Oh, margin, cool, I want to do that," but it's also part of your greater portfolio, your TFSA, your RRSP, whatever the case may be.
Yeah.
If you have room in your RRSP or your TFSA, I guess maybe more your RRSP, does it make sense to use margin now, or what do you think about that?
Like use margin in your RSP?
No, like if you have room to contribute I'm thinking to the greater audience here. Yours
Yeah.
is a very specific situation, but if someone was listening to this and they were like, "Oh, cool! Like Paul's doing this, so that means I can start making money." And again, we're not financial planners or advisors or anything, but just like from your journey and how you're sort of sharing it, would you, if you did it all over again, would you start margin right away, or would you max out the RRSP and the TFSA and then look at margin?
Well, so my TFSA is maxed out, so I can't put anything there. And I can contribute to my RSP, but I'm not actually contributing anything to my margin account. So it's not like there's money, five, $10,000 that I could put in my RSP. It's just the margin that Wealthsimple is giving me. It's just the money that they're lending me,
What's backing it?
the TFSA.
It is the TFSA.
Yeah, you can link your TFSA to your margin account. I think the other thing you can do is just say you put in $1,000 or $2,000 in your margin account, then Wealthsimple will determine how much you can borrow based on how much you've contributed. But for me, I think the easiest thing to do was just link my TFSA. But of course, if I ever get margin called, that means they can pull money out of my TFSA to pay off whatever money I owe them, which is the
Right.
reason why I'm going for like as defensive positions as I can.
So I I did an interview with Robin Haney, who's doing the same thing, and
Yeah.
I sometimes feel like I'm learning online, which is opening yourself up. There's no doubt the audience that's watching this and your audience and mine are pretty big now. It's a lot of people if you were to think of like a hockey arena or something. So but I'm willing to put myself out there because I want to learn more and I find this interesting. So sometimes I'm better prepared than others, and this one I'm not. So can you kind of walk me through what margin get calling is? And I know some people are watching this, they're probably going to laugh at me, but there's so much to learn. It's one thing I didn't research. So I don't honestly know. What does it mean to get margin called?
So I don't, okay, I don't know the exact ratios. Like it's, like I said, they're 30%, right? That's the margin requirement. So I think what happens is, let's say you borrow 10,000 from Wealthsimple, right? So you got 10,000, put it all into H yield. Let's say you put it into HYLD. If for some reason the share price of HYLD drops, I think more than 70%, you get into a position where you owe them money. And again, I'm not 100, I don't know if it's 30% it has to drop or 70% for you to get that margin call. But eventually my portfolio would be so small that they would say, okay, now you owe us money, right? We're afraid that you're going to lose all of our money. So now we're margin calling you and you have to put enough money into that account to bring your balance back up to a certain level.
I see. So you're making money on the distributions and paying the interest off, but you're not paying the principal because the principal is invested in order to collect the distributions.
So I think, like, for example, right now I took out about 2,500 in margin, right? So this Friday I'm going to get paid. I think I'm going to get like a whopping $18 because I only had, before the ex-dividend date, I think I only had $1,000 or something in margin. But so on Friday when I get paid, from what I understand, what I get paid will pay off the interest first, and then it will pay off what I owe them.
I
So
see.
so if I owe them $2,500 in the loan that I've borrowed from them, the money will go towards paying that off. So if every month I keep paying a little bit of the margin off, eventually I should own all of those shares. I will.
Right.
It's kind of like a mortgage on your house, right? Every month you're making your mortgage payment. Eventually you own the house, right? So every month my dividends will be making like the mortgage payment on my margin account as opposed to me paying it off myself.
That makes a lot of sense because Robin had mentioned that he's being very conservative, and like the example that you gave, where this unfortunately this lady has invested all of it, then I can see why that would be a challenge. It's an interesting strategy. I'm curious. I didn't ask Robin this, but because we know that the market has been really strong for, I'd say, I guess, almost the last 2 years, and eventually it's probably going to change in a margin environment. If the market drops significantly, especially with covered calls or income funds, does that kind of scare you at all? I mean, I know it's not a lot of money, but
Well, that's one reason why I'm keeping it small to start with, right? Is because I don't want to end up owing a lot of money. And it's another reason why I'm not, for example, buying Alti or, MST or something that's very volatile in my margin account, no like single stock ETFs. And the other thing is, I think I could be wrong, but I think what's been driving the market a lot lately has been tech stocks, right? So instead of loading up my margin account with tech stocks, I'm doing kind of like the opposite. I'm buying stuff that should be more defensive position so that when tech crashes, find a lot of people when they decide they're going to get out of tech, they sell their tech shares and then they put them into like banks and oil and utilities because they want to hold their money somewhere, or cash. I guess you could always hold cash. But so at that point in time, hopefully the stuff that I'm holding will actually do well, or at least not drop significantly to the point where I end up getting margin called.
Right. Yeah,
Yeah.
definitely gonna research it. I think it'd make a good individual video topic for my channel because I'm sure there's a lot of people that may be in a position to do it. I'm not sure that I am, but I'm very intrigued by the whole thing. Like I said, guys, it's
It was honestly,
sometimes it,
it was the last thing I thought I would ever do. You know what I mean? But
yeah.
I don't know if you've noticed recently, like you said, Robin Haney is now using margin. Jordan is, using margin. It seems like more and more people are, taking the risk to use a bit of margin with their portfolio. And so I decided to go for it as well.
Yeah. I
Makes for a good
think
case study as well, right?
yeah, it certainly does. I guess I learn the more I do this, the more I learn about my own risk tolerance. I like your approach and Robin's in the sense that you're not going, like if they gave you, I don't know, 50 grand and you put 2,500 in,
Yeah.
it's like dipping your toes in, trying to feel things out and understand it. I think I would take the same approach if I was to do something like that. Um, and then obviously there's the risk reward. So what in the end are you getting out of it? I guess the money in the beginning is a small amount. It's like I guess it's a long-term game too, right? You're not going to see any real, like you said, till you pay off that initial investment, you're not going to see a great deal in the beginning. It's definitely interesting. And also like, you know, I've heard this in some audiobooks and whatnot that the rich don't get rich by just using your own money. You
Right.
have to use other people's money. Not that necessarily we're trying to get rich, but we're trying to maximize the growth in the portfolio. So it's got me intrigued. I want to learn more. And what I was saying before is I feel silly opening myself up, but that's why I started this channel. And I'm pretty sure that you're in the same boat. You like sharing your experiences, and it can be embarrassing. Sometimes people comment, and you feel silly. We're humans, but I learn a lot from these conversations rather than me just babbling on about something that maybe I don't totally understand.
Yeah. And I
Here's
think,
one other one. If covered call ETFs cut distributions in a real downturn, which they can do, which we talked about, so what pays the bills then in sort of a portfolio like yours?
well, I think um, if you do follow Adriano, like I do, going back 5 years now, what he noticed along his journey, because back in 2020, he had like 75 different positions in his portfolio. Believe it or not, like 75. He had stocks, REITs, covered called ETFs. He had some closed end funds, split shares, everything, right? And what he noticed was that when the market crashes, right, some split corps, I don't know if you know what split shares are, but split corps, they can cut their distribution, right?
Yeah,
REITs cut their distributions. Some stocks like Algonquin Power, cut their distribution. But covered call ETFs never cut their distribution completely. They might lower it, right? They might
yeah,
bring it down a bit, but it never goes to zero. So they always continue to pay, right? So I think that as long as they're still paying something, and like I talked about, you got to have more than you need, right? I wouldn't retire needing $5,000 a month and your income portfolio is paying you $5,000 a month, because as soon
right,
as as soon as something gets cut, then unless maybe you happen to build the perfect portfolio of the most defensive, covered call ETFs that will likely never cut their distributions. But most people like myself tend to see ones like MST, where it's got the highest, monthly dividend, and you want that, right? Because it's the quickest way to grow your portfolio. So
right.
you load up on those ones, and yeah, eventually you're going to get cuts like we've seen recently. Um, but I think over the long time, like the long term, you're going to be fine.
Yeah,
Yeah.
yeah. It's it's still so new. I don't know that there's a lot of data out there to say one way or the other. I think the truth is we do know that I mean, I'm no expert. I'm I'm no Ben Felix, but
Yeah.
at the end of the day, we do know the performance of the funds is capped in one direction and not necessarily the other. And I like how you framed the fact that the options premiums will always be there. They will just be adjusted accordingly. And almost, I think you're
Yeah.
saying, like from what you've been describing to me, is the fund managers have to have some responsibility there. Otherwise, you get in a position like, I know we keep beating Alti up, but where
Yeah.
the people that are in that fund are scratching their heads going like, what are you doing? We're paying you money. And what are you doing here?
Yeah.
So I guess over the long term, you just have to know that if you set a goal, I guess, as an income investor for, like in my case, like it was 500,000, that's where I started, that you said that if you hit 500,000 and your distributions are X, well, you might need more than that in order to meet your goals because if they cut some of those, that might affect that in the long term. So with your portfolio right now, you are just over 400,000 and of course that's the unrealized changes because you haven't sold or anything, but what is the total distributions on a monthly basis right now?
For the past, I think it's 4 months now, 4 or 5 months now, I've been able to pass $10,000. So at the beginning of this year, I think I was just over seven. So in the course of the last, I guess, 11 months, I've been able to bring it up to 10,000.
And that's adding no extra money, right? You're taking $1,000 out every month right now.
Yeah, I took so far this year, I've taken out 16,750.
Okay.
Yeah.
And the changes in those distributions, is it from just buying different funds or are they changing their distributions?
Definitely from buying different funds. For example, Harvest has come out with their whole new suite, right? Like HHIS didn't exist last year, right?
Mhm.
Last year they had four funds. Harvest had four, their first four single stock ETFs that they came out with, right, with leverage. Um, Now there's 19 of them, right? So yeah, definitely buying new funds was very helpful in growing my 2024. I was really using Yield Max to kind of like build my monthly income. And we all saw what happened there, right? At the end of 2024 into 2025, they all kind of crashed. But thank goodness, actually, Harvest came out with some of these new funds. And then after they came out with new funds, Hamilton came out with their Daymax series. And, now Evolve's got their, I think they call them their ultra yield or something like that. They came out with Biggie and Canny. So yeah, a lot of Canadian companies have come out with higher paying, but not higher paying like the States was doing, right? Not like your 80, 90%. So,
Right.
but that's
So
now on top of that, Darren, just to point out as well, though, it's also about reinvesting every month, right? So I have more shares now of certain funds that I had, 12 months ago.
right, and that was gonna lead my next question. So we know how much you're making on a monthly basis. Have you ever looked at what the stock appreciation is, like in its price? Because for growth investors, that's where they see the change. So the 10,000 you see in distributions, I'm going to suggest is generally in the price of the positions that most growth investors hold. Do you know what any of the change in those is?
I do follow positions, right? Like for example, I hold one from Harvest that I used to have it, has NVIDIA in it, right? Which is their NVHE. And I think about 8 months ago or whatever, it was down a lot. I can't remember exactly what happened, but something happened with the share price of NVIDIA and it dropped down. I was losing thousands and thousands of dollars on that position. Well, eventually NVIDIA recovered, so did NVHE, and it got to the point where I was in the green and I decided to sell and realize all those gains. So sometimes I do sell positions and realize the gains. And the reason why I did it was because um, it was worth more than HHIS was. So I could sell my shares of NVHE, buy HHIS, and go from 22 cents a month to 25 cents a month. So I got an extra 3 cents a month. Now, since then, NVHE increased their distribution to, I think, 25 cents a month, but HHIS is now at 27 cents a month. So Yeah,
Right.
there are times when I will sell a fund because it's doing so well and realize the capital gain and then just deploy the money into something else.
Like I said, some of this is pretty interesting when I think about the different strategies. So, with
It's
growth investors, generally speaking, you're rebalancing once a year. So, you set your asset allocation, and obviously, in the case of something like XEQT, you don't even need to do that because
yeah.
it does it rebalances on its own. For part of my portfolio, I have to look at it annually. That's what most growth investors do. So, what it sounds like to me is on one hand, you're paying a fund, and I'll just use Alti because I know it off the top of my head, 1.4% to the fund manager to manage it. But then you are also actively managing those funds based on what you just told me on, I would assume, a weekly or monthly basis. So, what I'm thinking is, and my question is, if I'm working full time, I'm a parent and I don't have a great deal of time. So I'm putting this on you. If you were in that position, do you think you could keep up with all of what you're doing right now to manage that portfolio?
Yeah, you know what, Darren? I probably over manage my portfolio. I do have some friends that are also in like, covered call ETFs. But when I ask them, like, hey, did you see, what HHIS was selling at today? And they'll be like, oh, I haven't opened my Wealthsimple in 2 weeks. Right? Where myself personally, I don't go a day without checking it out. You know what I mean? So yeah, I think it depends on you personally, whether you want to be that kind of person who's always active and checking things out. I do get, I mean, I get daily dividends now, right? I get dividends Monday, Tuesday, Wednesday, Thursday, Friday, every single week. So there's always something going on in my portfolio. But if I really wanted to, I could just, close my Wealthsimple, leave it for a few months and then check it out in a few months from now and go, oh, hey, look, I got, $15,000 worth of dividends. What am I going to buy today? Right.
Right.
Yeah. So
Hmm.
I mean, I am probably more active. And what I think at the beginning of this video, I told you, I am trying to streamline my portfolio. I want to reduce how many positions I have and get to the point where I don't really have to worry about it as much as I have been. Now that I'm at that point where I'm making $10,000 a month, which is way more than I ever made working, right? Now I want to focus on kind of like the foundational positions, the ones that hold the S&P or hold the Nasdaq, you know what I mean, that are less volatile. They don't pay as much money, but they're more reliable, right? And
Yeah.
build those positions and then, get to the point where maybe I don't look at my portfolio very often and just you can even put things on drip or whatever.
Yeah, I was thinking about I've held HYLD right from the get-go, and the share price on HYLD hasn't really changed a great deal compared to some of the other funds, aka Alti, or some of the other yield max funds. It's like a steady eddy, and then its distributions are fairly consistent. They do change with market conditions and stuff like that. Holding something like that would make your have to do far less, I suppose.
Yeah.
And it I find it fascinating in the sense that I look at my stuff daily too, I guess, just for more interest sake than anything, but not a lot is going on. There's certain distributions and dividends that come out, but it's like on a certain day of the month or whatever, where there might be some money that I need to reallocate that's sitting in there. I don't have a lot of drip on. Some I do, some I don't. So there's a little bit of that going on with me, but certainly not as much as you. And like you, I don't know that I would want to worry about it every day, but it also stimulates you. It's like well, it's the psychological piece, I guess. It's kind of fun.
Yeah. Well, and I spent the better part of the last 5 years watching a lot of YouTube, guys like Robin Haney and, the Canadian in a T-shirt and Adriano and, other YouTubers, just trying to learn as much as I can and try to build my income to the point where I could retire. And I've gotten kind of to the point where it's like, I don't really watch videos that much anymore. I might watch one or two a day, but not like I used to consume them. Now it's more a case of us making videos, and trying to put out our own content as opposed to watching other people's videos. Um,
Yeah, I mean, for my research, I do read and watch other videos to hopefully drill the content down because, as I said, I'm still a novice and still learning, and I don't want to steer people in the wrong direction. But you're right, the content creation, it does take a lot. Just shooting this alone, we've been at it for an hour and 58 minutes. And when you guys watch this, it'll be probably about 60 minutes. So there's going
Yeah.
to be a fair bit of editing to this video. But I'm truly enjoying these conversations. I know today was pretty laid back. We didn't have too many prepared questions for each other, but I've found that the more we talk, the more it opens up some understanding, I guess, of the different strategies. It makes me ask a lot more questions, that's for sure. But that was one of the reasons I wanted to do it. And I know you had said at one point that people paint you as some mafia person as far as covered call goes, but I like how
Oh, the
genuine you are
income
about your
income Nazis.
yeah. I like how genuine you are with the audience and sharing your experience, and you've opened up a new chapter by saying, "Look, I recognize that I'm going to need a little bit of growth, and I'm going to introduce that in my portfolio." And yeah, that's pretty cool. So if you want to understand how cover calls behave when the market moves, this episode was your first real test, and the next one's going to be even better. So make sure you check out Paul's channel. I'll link it in the video description below. And if you want to see the full breakdown of my portfolio and what I changed this month, you should watch this video right here.